So a big part of what is happening at the financial markets, offering stocks, for example, and demanding stocks, is not focused and not linked with real economy, but is only the change from one to the next, to the next, to the next, to the next owner of this stock. And the consequence for the real economy is nearly, is relatively low. There is a tendency that these financial markets, and this may be one with the stocks, that they develop in a way more and more disconnected from the real economy. So I painted here several of these financial markets. There are, for example, the bonds, the public bonds, and also bonds by private corporations, which have a fixed rate, but their price on the market changes nevertheless. And this is another part of the financial markets. Then there is a market of currencies. Currencies from other countries usually, or many people think they are needed to buy and pay goods and services in another country with another currency. And then one has to exchange, for example, euro and dollar. This is one part of the total. But meanwhile, it is said that 97% of the international transactions with currencies are not linked with real economic facts and transactions, but only with speculation. They speculate on changes in the exchange rate, and they may be very, very low, but because the money can be moved by computer system and worldwide net, then big amounts of money can be moved from here to there, from United States to Japan, from Japan to Europe, from Europe to China, and so on. And even very low changes in exchange rate are the object of speculation, and so a growing part of the money flow, meanwhile, is happening in this sphere, in this speculative sphere. Well, what is the problem? They should do this kind of transactions. A lot of what is happening there has a character of wagers. One assumes the exchange rate at that and that time will be so at that point, and the other assumes maybe higher, and then there will be made up a wager. It is like in a casino. So therefore the expression, the word casino, capitalism. If this is happening, if more and more of this money is flowing into the speculative sphere, the prices of the assets, for example of stocks, are not anymore really linked with what the corporation produces and has an expectation on profits. But it is the result of the overflow, of the flooding of the financial market. I will show it with this graph. There is some, this is the time here. There is some reason for the development of the prices of stocks in the expected profit of a company. But if now this is the price and this is the quantity of offered and demanded stocks. Let's say this is demand and this is supply. Now this means supply. And this coming together of supply and demand leads to the actual price, if the price is development of price is liberated, is not controlled, is not by intervention. So this is the price on the basis, of the decisions of suppliers and demanders. If now, by this influence, or better exfluence, the money flows out and flows now into the financial market, the supply of money, the demand of stocks. The demand of stocks is developing into this direction. More and more demand for the stocks, and this means that the price of the stocks is going up. Not because the companies are producing in a better way with more expectations and profits, but only because overflooding of financial markets with liquidity which is flowing out of this context. To come back to this graph, here also is the price of the stocks. It leads to a development of prices which disconnect from the real economic basis. More and more into illusionary dimensions. And this can escalate because if several important investors go into this speculation and then the price really goes up, they draw maybe 100 times of their financial volume as wie eine Hammelherde. How is it called? The sheep. One is the Leithammel, one is the leading sheep, and hundreds of others follow the leader, the leading sheep. And such kind of pattern is happening at the financial markets. So it is also called the self-fulfilling prophecy. Many expect that the prices go up. Because they expect, they demand more and more of these stocks or several others. And as a consequence, the prices of the stocks at the stock markets, they go up. So their expectation is supported by what happens. And this is the reason why they feel, they were on the right way. And so it can escalate. But this is not possible on the long run. There is some tension building up. And this tension, again, has to discharge. And the discharge is the crash at the stock market or at the financial markets in general. We had this crash worldwide in 1929.